Welcome to Empire Economics. I'm grateful you're here, because what you're about to learn might completely change how you see money. Right now, a quiet process is reshaping the value of every dollar, pound, and euro you own. It's not a crash. It's not inflation. It's something far more subtle. It's the reason your savings lose power, even when the numbers in your account go up. Most people never see it happening. But once you understand how it works, you'll never look at your bank balance the same way again. If you care about protecting what you've earned, hit subscribe, tap like, and drop a comment saying, "I'm paying attention." Now, let's uncover how this system really works. Every government promises to protect your savings. Every central bank swears they're working in your best interest. Every government promises to protect your savings. Every central bank swears they're working in your best interest. And every time, there's a quiet mechanism running in the background that does exactly the opposite. It's called financial repression. And if you've never heard that term before, there's a reason. Because understanding it means understanding how your wealth gets transferred away from you without you even noticing. Financial repression isn't some shadowy conspiracy theory. It's an academic concept with a formal definition, documented policies, and a track record that spans centuries. The term was coined by Stanford economists Edward Shore and Ronald McKinnon in 1973. But the practice is as old as government debt itself. What they identified was a pattern of policies designed to channel your money toward government coffers at rates below what the free market would offer. Think of it as a financial detour that redirects your wealth away from where it would naturally flow. Here's how it works in practice. When you deposit money in a bank, that bank traditionally lends it out to borrowers at market rates, keeping a spread for profit while paying you interest on your deposit. But under financial repression, governments create rules that force banks to buy government bonds instead. Those bonds pay lower rates than what the market would demand, which means banks earn less, and ultimately, so do you. Your savings become a captive source of cheap funding for government spending. The beauty of this system, from a government perspective, is that it feels invisible. You still get interest on your savings account. You still see positive numbers on your statements. But when those returns consistently fall below the rate of inflation, your purchasing power erodes year after year. It's a tax that never appears on any bill. A transfer of wealth that happens in broad daylight while wearing the disguise of financial stability. Consider what's happening right now. Global public debt has surpassed $100 trillion in 2024, representing 93% of global gross domestic product. The International Monetary Fund projects this figure could reach 100% by 2030, levels not seen since 1945. With debt burdens this massive, governments face what economists call a fiscal policy trilemma. They must address the costs of security, aging populations, and climate change without either destroying debt sustainability or triggering political backlash against higher taxes. Historically, when faced with this impossible choice, governments have consistently chosen the path of least political resistance. Rather than cutting spending or raising taxes explicitly, they implement financial repression. It allows them to reduce debt burdens while avoiding the immediate political consequences of austerity or tax increases. The cost gets spread across millions of savers who may never realize what's happening to their wealth. The United States provides a perfect case study. With national debt standing at $36.2 trillion, the pressure to find alternative funding mechanisms has never been greater. Federal Reserve policies that keep interest rates artificially low, regulations that require banks to hold government bonds, and pension rules that funnel retirement savings toward Treasury securities all represent forms of financial repression already in operation. But America didn't invent this playbook. The Bank of England, established in 1694, was created specifically to solve King William's funding crisis during his war with France. Parliament chartered the bank in exchange for it lending £1.2 million to the Crown at 8% interest. Given England's precarious financial situation and recent political turmoil, These were remarkably favorable terms for the government. The bank's shareholders became aligned with the Crown's interests, creating a captive source of funding that prioritized government needs over market efficiency. This historical example reveals the fundamental mechanism that makes financial repression so persistent. Once financial institutions become dependent on government support and regulation, they lose the ability to allocate capital based purely on economic merit. Instead, they become tools of government finance, channeling private savings toward public spending, regardless of whether those investments generate the highest returns. The consequences extend far beyond individual savers. When capital gets redirected away from productive private investment toward government consumption, economic growth suffers. Research suggests financial repression can reduce growth by 0.4 to 0.7 percentage points annually. That might sound small, but compounded over decades, it represents trillions in lost prosperity and opportunity. Modern examples demonstrate how quickly these policies can escalate. Argentina seized $29 billion in private pension funds in 2008, claiming it was protecting workers from market volatility. The real motivation was accessing those funds to service government debt and avoid default. What began as temporary emergency measures became permanent features of the financial system. The sophistication of today's financial repression makes it harder to detect but no less damaging. Complex regulatory frameworks, quantitative easing programs, and yield curve controls all serve the same fundamental purpose as the crude coin debasement of ancient empires. They transfer wealth from savers to borrowers, from the private sector to the public sector, from future prosperity to current spending. Understanding these mechanisms isn't about pessimism or conspiracy theories. It's about recognizing patterns that repeat throughout history and preparing accordingly. When you know how the system works, you can make informed decisions about protecting and growing your wealth despite the headwinds. The question isn't whether financial repression will intensify. The question is how prepared you'll be when it does. The most insidious aspect of financial repression is how it disguises itself as protection. Governments don't announce they're implementing policies to drain your savings. Instead, they frame these measures as necessary for financial stability, economic recovery, or national security. The language is always reassuring, even as the underlying mechanics work against your interests. Take quantitative easing, a term that sounds technical and benign. Central banks create new money electronically and use it to purchase government bonds and other securities. Officials present this as stimulating economic growth and preventing deflation. But the practical effect is that asset prices rise while the purchasing power of cash declines. Those who own stocks, real estate, and other assets see their wealth increase. Those who hold cash savings watch their relative position deteriorate. This isn't an accident or an unfortunate side effect. It's the intended mechanism. By inflating asset prices while keeping interest rates below inflation, financial repression systematically transfers wealth from savers to asset owners, from the middle class to those wealthy enough to hold significant investments. The policy achieves its goal of reducing government debt burdens by eroding the real value of both public and private savings. The regulatory component adds another layer of compulsion. Banks face capital requirements that heavily favor government bonds over private loans. Insurance companies and pension funds operate under rules that mandate significant holdings of treasury securities. These aren't market-driven decisions, but regulatory mandates that create artificial demand for government debt, while starving productive sectors of capital. Consider the sovereign bank doom loop that emerges from these policies. Financial institutions become loaded with government bonds, making them vulnerable to any decline in government creditworthiness. When sovereign debt faces pressure, bank balance sheets deteriorate simultaneously. This creates a mutual dependency where banks need government support to survive, while governments need banks to purchase their debt. The relationship becomes circular and increasingly unstable over time. Japan offers perhaps the most comprehensive example of long-term financial repression in action. For over 3 decades, the Bank of Japan has maintained near zero interest rates while purchasing massive quantities of government bonds. Japanese savers have earned virtually nothing on their deposits for an entire generation. Meanwhile, government debt has grown to over 250% of gross domestic product, sustained only by captive domestic savings and central bank intervention. The Japanese experience reveals both the persistence and the limitations of financial repression. While the policy has prevented an immediate debt crisis, it has also created economic stagnation, demographic challenges, and a financial system increasingly divorced from market realities. Growth has remained anemic, innovation has declined, and younger generations face diminished economic prospects compared to their predecessors. European approaches demonstrate variations on the same theme. Negative interest rates in countries like Germany and Switzerland directly tax cash holdings while forcing banks to pay for the privilege of holding reserves. Meanwhile, European central bank policies require banks throughout the Eurozone to purchase government bonds as part of their regulatory capital, creating artificial demand that keeps borrowing costs artificially low for heavily indebted member states. So there you have it. Financial repression isn't coming. It's already here, woven into the fabric of modern monetary policy and disguised as economic necessity. From zero interest rates to regulatory mandates, the mechanisms that quietly transfer wealth from savers to governments operate in plain sight, hidden only by complexity and comforting rhetoric. The patterns repeat because the incentives never change. Governments will always choose the path that spreads costs across millions of people rather than confronting fiscal reality directly. And that path runs straight through your savings account, your pension fund, and your purchasing power. But knowledge changes everything. When you understand how these systems work, you can navigate them more effectively. You can recognize the difference between genuine economic policy and wealth transfer mechanisms. You can make informed decisions about how to position yourself in an environment where traditional savings vehicles may no longer serve their intended purpose. History shows us that financial repression eventually reaches its limits. The question is whether you'll be prepared when those limits are tested. This content is for educational purposes only and does not constitute financial, legal, or investment advice. If this gave you a new perspective on the forces shaping your financial future, hit subscribe. Understanding the game is the first step to playing it better.